Hello, everyone, and welcome to today's Lunch with Mia, Planning for Retirement. My name is Kiana Walton, and I am your moderator for today's event. We're going to do a quick poll just to see how everyone heard about today's webinar. If you do not see or are not able to use the poll, you can just put in the chat how you heard about today's webinar. Okay, and it looks like we mostly got here today by email, so I appreciate you all being here. Thank you. So do you know how much your retirement will cost? Have you considered how you will pay for it? For many current and future retirees, these can be stressful questions which are often put off and left unanswered for too long. A lot of people get so overwhelmed about saving for an unknown future that they end up not saving anything at all. You work, you save, and then you retire. But while the mechanics may be the same, today's savers are facing some challenges that previous generations didn't have to worry about. To help provide us with some tips to address these questions, we have a great line up of speakers and some great information for you. But before we get started, just a few housekeeping rules. This event is being recorded. Please leave phones and computers on mute for this event. If you are not presenting, please keep your camera off. If you have questions for today's speakers, please use the chat box and make sure your questions are sent to everyone and not just the speaker or host. And we will save the questions for the end. So for our first speaker for today's webinar, we have Christina Figueroa from the Maryland Cash Campaign. Thank you, Christina.
Thank you so much. Thank you everyone for joining us. Next slide. So again, my name is Christina Figueroa. I'm a program associate for financial capability with Cash Campaign of Maryland. CASH is an acronym which means Creating Assets, Savings, and Hope. Next slide. Before we begin, I wanted to tell you a little bit about Cash Campaign and our programs and services. So we provide free tax preparation in Baltimore and across the state. We have financial education workshops and conferences, benefit screening for up to 22 different public benefits, not including Social Security and veteran benefits, financial coaching, financial fitness fairs, Maryland Cash Academy, which includes a lot of webinars and some in-person classes from partners and Cash itself on all different kinds of topics, financial education topics, and these are free. We also work in advocacy and policy, and we have the Bank on Maryland program, which can provide you information about low-cost, safe, functional accounts with banks and credit unions. For more information about any of these programs, I invite you to visit our webpage. I am putting it in the link, and it is cashmd.org, cashmd.org. Next slide. So today we will be talking about the why, what, where, and how. So learning how to save for retirement, you really need to consider why you're saving, so what you value, what your goals are, including SMART goals, where you're going to be saving and investing, so the different kinds of products and what to know before you begin investing, and how to save, so how to find the money and to save and invest, and we also have some saving tips for you. Next slide. So if you can all do me a favor and just take a moment to envision your retirement. Put down in the chat the first few words or the first phrase that comes to mind, and then I'll share some of those with the group. And there is a reason I'm asking for this. So thank you for those who are putting this in. All right, so we have a couple answers coming in. I see anxiety, enjoy, comfort, vacations, finally, very true. After working for a long time, finally is very, very on the dot. Needing enough money, rent and mortgage. Perfect. Thank you so much for everyone for participating and putting that information in the chat. Next slide. So the why behind your retirement savings is actually incredibly important. Any kind of successful plan is going to depend on goals that are rooted in your values and the things that matter to you. This not only is going to help you to ground your behavior so that when you are thinking about saving, you are actually, this isn't something in the background about something that may happen in the future, but something that you need to focus on now. And that will help you actually save, provide some motivation. It will also help you really understand your expenses in retirement. They may not be the same as your expenses right now. So all of these things will make a difference. You will want to sit down with yourself and have a conversation. If you have a partner that you're also, or family or whoever else that will be involved in those decisions, you will want to make sure that they are there for that conversation. But you'll want to think about what will bring meaning to your retirement. So how do you want to spend your retirement years? What matters to you? Security, financial freedom. For most of us, it's a combination of both. What is your desired lifestyle? So some people already said this: vacations, travel, where you want to live, if you want to downsize or live with family, if you want to continue working or stop working. So some of us may be still working in retirement. And do you want to leave money for others when you pass away? So every family, every situation is different. You may want to leave money to a charity or to a family member. You may have people who have special needs in your life who you are currently providing for that you may need to continue providing for once you pass away. All of these things are really, really important so that you can be very clear on the expenses that you'll have and what your goals are. And I see we have another entry: joy at having time worry about finances. Exactly. So hopefully this presentation will help you manage a little bit of that worry so that you can really enjoy that time. Next slide. So depending on your stage of life, some of the things that we mentioned earlier, like downsizing, may not seem particularly relevant right now. If you're in your early 20s, you're thinking about maybe buying a house one day, not about getting a smaller one. Or, you know, when you're talking about where you're going to live, maybe right now you're also thinking about educational or professional opportunities, and you may not even stay in Maryland. So think of all the questions from the previous slide, but also if you can't answer all of them, that's okay. And you want to be grounded in financial well-being. So this is a state where a person is meeting their current and ongoing obligations. You have a secured future and you're able to make choices to enjoy life. The reason why I added this slide is because retirement is a phase. It is a period of time. It is not a moment, right? So for most of us, retirement is 20 to 35 years, depending on your particular situation. There will be a present and a future within that retirement. So if you find the other questions too overwhelming right now, and it's something that you're going to come back to at a later time, at least right now, think about present security, future security, present freedom, and future freedom. So really the ability to manage your day-to-day, absorb financial shocks, do things to enjoy your life now and to meet those goals. This is this financial well-being scale, and there's a ton of really, really good information and tools that you can use after this presentation, is from the Consumer Financial Protection Bureau. So I've just added the website to the chat. This is something that I highly recommend you click on, you go to, you save. There is a tremendous amount of information that will be really helpful for you as you go forward. Next slide. So now that you have an idea of some of your values, the things that matter to you, what you're going to be grounding those savings in, you want to think about what your retirement goal is actually going to be. So what are your goals going to be? Next slide. Whenever you're thinking of any kind of financial goals, And again, retirement goal plans and goals are extensive. It's not just a one-shot deal, right? But if you're thinking about that amount, which is what people often think about and others will talk about, which is like that total amount, you want to make sure that you're setting SMART goals. So you want to be specific, think about what will be done with the money, measurable, a dollar amount, attainable and realistic. So how will it be reached? This is often defined by a budget and the money that you have coming in, going out, and time bound. So you really want to be focused on the time. Next slide. So here we have an example of one goal. It says, I want to be financially stable in my retirement. That is not a SMART goal. We don't know if it's achievable, realistic. We don't know with a time frame. We don't have an amount. We don't have any of that. So what you want to do is you really want to focus on something like the second, which says, I want to save, invest enough so that I can retire and stop working at a certain age. So age 67, maintaining your current standard of living, and then funding with retirement with Social Security and retirement accounts, so others accounts. This is missing one of the critical factors, right? One of the critical pieces of information, which is how much do you need to save and is this achievable or realistic? Next slide. So MSRP will be covering how much you need to save. So they will be discussing that big number, the future value that you will have to save over however many years so that you will be able to fund your retirement. You'll need to consider a lot of things, right? So they'll be talking about this, but you'll be considering how long you plan to work in life expectancy. So the length of your retirement, when you plan to start saving. So that is going to, you have to take that into consideration. Healthcare needs. So your healthcare needs may change in retirement. And then other goals that are specific to you. So that can be, again, like leaving an inheritance, certain lifestyle, all of those things need to be taken into consideration. Next. So now that you know the X amount of dollars, the total amount, this is what MSRP will be discussing, is that total amount. That can feel incredibly overwhelming. And you also don't know how you get to X dollars 30 years from now from where you are right now today. So you're going to want to make a plan and you're going to break this down. This is going to be different for everyone. You're going to have different aspects to your plan. I can't give a blanket statement of what every single person's retirement plan will be. It will be different for everyone, but you may include SMART goals around understanding net worth. So you know where you're at, right? So understanding what your assets are and what your liabilities or debt is. Understanding cash flow. So when is money coming in and when is money coming out? You may want to do that like on a monthly basis so that you understand. Setting priorities. So most of us have other financial obligations and goals in addition to our saving for retirement, like mortgages, emergency funds. You'll want to create a budget if you don't have one, or adjust your budget if you need to. Think about managing that debt and set a monthly retirement savings and investment goal. So we'll get started with the monthly savings and investment goal. Next. So there are a couple of different ways to do this. One is doing calculations, one is doing estimates, and the other is starting where you are. So if you wanted to try to calculate, let's say that after you did all the math that Jeannie will discuss, you have a total amount. Once you have that total amount, you want to, you've decided that's 500,000. You want to pay the same amount every year for 30 years. You're assuming inflation is a certain percent and growth is a certain percent. So let's assume that inflation is 3%, growth is 6%. So you have 3% rate of growth. You can actually use this, calculate this formula to determine how much you will have to save every month, every year, and then divide it by 12 and you get the monthly amount. Again, this has a lot of assumptions baked in, but this is a way that you could, if you're just starting to try to figure out how much to save, depending on your total amount, which MSRP will discuss, this is a way to start that. Next slide. If you feel overwhelmed and don't want to do a calculation, which I recommend doing calculations for everything because everything is incredibly specific. But if you're not ready for that, if that's not somewhere you are, you can consider estimates. You just have to be aware of assumptions. So There are certain rules of thumb. Some people suggest 10 to 15% of your current monthly income to maintain your current lifestyle. Again, that's making assumptions about getting Social Security income, having healthy growth of investments, having the same expenses today as you will in retirement. So you really need to think about that. If that's where you're going to go, you're going to have to think about it beyond that initial thought. There's FIRNA, Financial Industry Regulation Authority, has an investment calculator. Again, there are many assumptions. They're all listed on their website, but that's another potential way to consider this, to think about how you might be able to calculate that monthly amount. Next. And the other way, if you find 15% of your current monthly income seems incredibly overwhelming, these other numbers seem overwhelming, you're not going to do it at all because you're so overwhelmed and you feel so far behind that you're not even going to start where you are. So create a budget to determine what you can save now and what changes you can make. So what is your income now? What are your expenses now? Consider all streams of income, all of your expenses, subtract income from expenses, and see what you can actually put away, what you can change so that you may be able to decrease some spending, increase some income, and put more money into retirement. Next. This is an example of something that you can do, is create an action plan by establishing your goal, calculating your savings target, thinking about where the money will come from and where you will save. Next. So Andrea had $40,000 in income, had a 7% match from her employer. She didn't want to do any, she just decided this is what I'm going to do. For her, she would have to calculate how much that will be a month. And then she would have to look at her budget and see how she can make that happen. This is her particular way of doing it. You may want to actually do the calculations or look at those estimates. Next. This is just kind of an idea. For any goal, you want to have a goal, an action plan, and steps, and then follow through. Next. Again, CFPB has worksheets that can be helpful here. Next. If you need help figuring out how to do your budgeting, start building, doing credit, we have a financial coaching program that is free. You can just text Cash Coach to the phone number 646-349-5959. I'm going to put that in the chat for you all. And that way you can get connected with them. They can't help you determine your retirement plan, but they can help you at least get started on working on your budget, setting up savings, looking at your credit and your debt, and help you get going so that you can then really work on your retirement goals. Next. So where to save and invest. MSRP will be talking about retirement accounts, including 401k and IRAs, and the Maryland administration will discuss annuities. Next. Many people will be saving and investing as well as doing retirement accounts. So just make sure to remember that if you're saving in an insured bank or credit union, those will be safe, low risk, low interest. If you're investing, that will be higher risk, longer term, and you'll have potential for higher returns. Next. If you're investing on your own, you really want to visit investor.gov so that you can get more information about all of the different kinds of accounts that exist. And just get more, they have a lot of investor education. Next. If you are going to be paying somebody, you want to make sure that you check out your investment professional and that you are very clear on their record and if they are doing things the way they should be doing them. Next. Before investing, you want to know who's going to be regulating the investment. You want to be committed to it. And you may have to kind of shed a little bit of fear, but really be aware of the current state of your investments. Next. You're going to want to look at the timeline. So this investing is generally for longer term to weather ups and downs. Closer to needing the money, you're going to reduce risk. Farther from needing the money, you're going to increase risk, potential higher returns. Again, I can't provide any kind of investment advice. This is just kind of general education. Next. You want to ask yourself how the investment will make you money, if this is consistent with your goals, how you're going to get a return, what fees you have to pay, and the risks. Next. And here we have a couple of activities that you can do on your own. So I'll add these to the link to the chat, but this will help you kind of get an idea of your risk. So everybody is going to be different. Everyone will have a different risk tolerance. You kind of want to be aware of that. Next. Before you start investing, before you start doing that, or even if you've already started and you really haven't had the opportunity to check out everything, you really want to consider looking at some of these resources. These are different federal organizations that can really provide you information. So investor.gov is investor education from the SEC. NASSAA is the North American Securities Administration Association, and they do a lot of regulation, but they also have a section on investment education. The SEC protects investors, but they also, like I said, have investor.gov. FIRNA is a financial industry regulatory authority. So they regulate the financial industry, but they also provide financial education and have this really great thing called the Fund Analyzer. And then you may want to look at the news. So this is just an example, but you may want to kind of read a little bit about what's going on. Sometimes that can be a little bit off-putting, so you can decide how much of that you want to do, but I will include some of these different resources here. Next. So where will the money come from? Next. Making that budget. So really making that budget, understanding your cash flow, paying yourself first. So when you have tax refunds, bonuses, people think of gifts and inheritance as free money. It's not free money. Somebody worked for it. And it is not free money when it was earned, and it's not free money when you get it. So you want to take that money into consideration and consider putting that into your retirement savings. You may have to reduce expenses. Knowing the difference between spending less and saving more. Sometimes people say, I spent less on the shirt, but then you spent the money from the less on the shirt on a pants. You didn't save. You spent less on one thing and more on another, but you want to remember spending less only translates into saving more if you move that money into savings. You may have to increase income. Take the free money. So like Andrea, you want to take advantage of any kind of employer retirement account matches, and you want to understand all of the saving and investment account fees and make sure that you're not losing money that way. Next. And lastly, we have some retirement savings tips. So again, if you haven't started saving yet, start today. Take advantage of any kind of match and really understand what your employer is providing for you. Make it automatic. If you make it automatic, that will help you. Learn about employer's pension if they have one. If you're 50 or older, take advantage of catch-up contributions if you need to. And also really think about managing your debt and remembering that every little bit counts and not to get discouraged. Again, if you are just starting, or even if you're not starting, but you're feeling overwhelmed, you're trying to figure out what to do, we have financial coaching that's free. They cannot tell you how to plan for your retirement, but they can help you figure out your budgets, start getting into savings, looking at debt, looking at credit, all of those things which you really need to consider so that you can find that money to save in retirement. So I'm putting that information here for the financial coaching again. And next. And that is it for me for today. So thank you so much. I appreciate your time.
Thank you, Christina. We're going to keep it moving. So we're going to move to Jenny Sutton with the Maryland Supplemental Retirement Plans.
Thanks, everybody. Yes, my name is Jeannie Sutton, and I am with Maryland Supplemental Retirement Plans, and I'm a member services education specialist. So I'm really happy to be here. And I can't reiterate enough the things that Christina had said. Learn those SMART goals, learn that acronym. And that is good, not just for money, but throughout life, having those SMART goals. So also I can't stress enough the whys for retirement. And so Christina spoke about saving, and saving for retirement is a great idea. And not only a great idea, it's a necessity. So, but how many of you feel that you've actually saved enough or are saving enough for retirement? If you've wondered how much do you really need to save? Unfortunately, I can't give you the magic number, because that magic number all depends on your situation. There's no one size fits all answer, but there are a lot of variables that you need to consider. And so hopefully we'll give you something to think about that will draw you and get you to that number. And then you can go to Christina and she can help you save and give you the ideas for actually saving for that number. So with that, if you could change slide, please. Okay. So before we get into knowing how much you need, you first have to ask yourself, how do you envision your retirement? Christina had mentioned that too. And it's something that you really have to think about. You have to know the whys, where will you live? Will you be traveling, or will you be doing the hobbies that you didn't have a chance to do while you were working? So all of these play into how much do I need for retirement? So even if you haven't given thought to the type of retirement lifestyle that you want, you should still aim to replace about 80% of your pre-retirement income. And that is what financial advisors will suggest. So that gives you a starting number. And now keep in mind, it depends on when you are retiring. If you're closer to retirement versus several years out, several decades out, then that number may change. But ballpark, about 80% of your pre-retirement income should be the number that you shoot for. Now, the other factor that you have to keep in mind is that you need to plan for a long retirement. We're going to say, statistically speaking, retirement can last 25 years or more. So in some cases, some of you may be in retirement longer than you were working. So you want to plan for that as well. And then you want to consider inflation. And we've gotten a good dose of inflation lately. So you can see you've got to build that in planning for retirement. And I want to note here that planning for retirement is a process. It's not just, okay, let's do a one and done thing. You need to really run the numbers on a yearly basis. And as you get closer to retirement, you might want to run those numbers even more frequently. But you want to build in inflation, and there are things that we can control and we can't control. We can't control inflation. However, we can control the spending and the expenses that we will have. Now, keep in mind, some expenses may increase, such as the travel or that pursuing that hobby that you didn't have a chance to pursue. And then, of course, as you get older and you're in retirement, medical, dental, even long-term care may be a consideration. And then, of course, we like to spoil kids and grandkids. So you want to build that into the budget as well. And some of you may be relocating. So you may not stay in Maryland. So you may be going outside. Now, some expenses may decrease. If you are currently traveling for business, you may not be doing that anymore. If you currently pay union or professional dues, you may not be paying those. Also, when you do leave your employer, you will no longer be able to contribute to a 401k plan or a 403b. And then some of you also may not have a mortgage, so that's a great place to be in. But again, these are things that you have to think about when you are trying to come up with that number of how much will I need. So, think about that. It doesn't hurt to do your income and expenses and start looking at that budget. So if you could, please change the slide. So we're going to look at some of the possible sources of income during retirement, and I'm going to talk a little bit more detail about some of these, but look at your Social Security, and you have to decide whether you're going to take your benefit early or at full retirement age, or delay taking your Social Security. Will you have a pension, which is technically known as a defined benefit plan? Now, a lot of private industries have done away with pensions, so you don't want to confuse that with a 401k, or for those in nonprofits, the 403b, and for those working for municipalities, the 457. Have you saved in IRAs, individual retirement accounts? These are not associated with an employer plan. Do you have traditional IRAs or Roth IRAs? And do you have other investments that are earmarked specifically for retirement? And then a part-time job. Our goal is to help you get to the point where you are working because you want to, not because you have to. So that part-time job, will that be a necessity, or is that part-time job to keep you out and active? So again, these are the things that you have to consider, and you have to see if there is a gap. AARP.org, they do have some retirement calculators and great resources that Christina had mentioned earlier. So take advantage of those resources. Okay, next slide, please. Okay, I want to take a moment and talk about Social Security. You need 40 quarters to actually qualify, be eligible to receive a Social Security benefit. Now, 40 quarters, really what that adds up to for most folks is about 10 years of working. So if you haven't done so yet, please go over to the Social Security website. You can go to socialsecurity.gov/myaccount. That will get you right to where you need to be to create a username and a password on My Social Security. You want to do that because Social Security has stopped sending out statements. So if you are under age 60, you will no longer and have not received a statement in quite a few years. So if you need to know where you stand, you need to go over there also to get the information that you need that will help you in planning for your retirement. You'll be able to pull up your benefit statement. Your benefit is based on your 35 highest years of earnings. So you want to keep that in mind. Now, your full retirement age is the age in which you are entitled to receive 100% of your earned Social Security benefits. So you can see on the chart here, if you don't know what your full retirement age is for Social Security, you look at your year of birth, and then you will see what your full retirement age is. So please, I can't encourage you enough to go over. The other thing I want to remind you of is that if you haven't created a username and a password for your Social Security account, you want to do that specifically to help keep fraudulent use of your Social Security number. If you don't recall creating a username and a password, and you go on and you see that you do have a username and a password, then that might alert you that you have fraudulent activity on your Social Security information. So again, you want to go over and do that as soon as possible. So next slide, please. Now, when it comes to Social Security benefits, as I mentioned, there's a full retirement age. But if you have enough quarters, then you are actually eligible to start taking a benefit at age 62. However, if you do start taking a benefit prior to your full retirement age with Social Security, then your benefit amount is forever reduced. So looking at the example here, in this example, this assumes that this person's full retirement age is age 67. And this assumes that their benefit amount at age 67 would be $1,000 per month. Well, if we look at the chart, we can see if they start taking that benefit at age 62, then their benefit amount is only $700. It's not $1,000. So that benefit amount is reduced about 30%. And that benefit amount is always reduced. It's not like once this person turns 67, they will pop back up to $1,000. It doesn't work that way. So if you take your benefit amount early, it is a reduced benefit. If you wait until your full benefit age, then in this example, the person would receive $1,000. You don't have to take it at your full age. If you are still working, you plan on working for a while, and you don't need the additional income, then you would want to go ahead and maybe delay taking your Social Security benefit. And what that does is that it increases the amount by about 8% or so each year. So if this person decided to wait until age 70, then they could go ahead and have their benefit, which is much more than their full amount. So there's a lot of things to consider when taking that benefit, your health status, your life expectancy, the need for the income, and then whether or not you do plan to work either part-time or full-time in retirement. And then also you want to take into account survivor needs. Keep in mind that for a married couple, now, if both spouses are eligible for Social Security, they will both receive Social Security checks. However, once one spouse passes, the surviving spouse is entitled to receive only the higher of the two benefit amounts. They will not continue receiving both checks. So you've got to build that into your plan. So what I would suggest, if you are married, then what you would do is run the calculations 3 different ways. Both spouses are living, they're active, they're able to generate a Social Security income. Then you've got to look at it. Spouse A passes, what does the situation look like for spouse B? And vice versa. If spouse B passes, what does the situation look like for spouse A? So again, you've got to put all this information together. Next slide, please. Okay, so this is one chart that I really like because if you haven't started saving, this might motivate you to save and save as soon as possible. When we're in our 20s and 30s, retirement seems like it's so far away. But that is actually the best time to start saving for retirement. So in this chart, for example, it says time is money, and this is a monthly investment of $100. And if someone starting out at age 25 starts investing $100 on a monthly basis, and they contribute that $100 a month through age 65, that's $48,000 out of their own pocket. Now, given different rates of return, and we all know that the market fluctuates. Sometimes it's scary and sometimes it's not so scary. But given different rates of return, and here we're showing 4%, 7%, and 9%, over a 40-year term of saving, a 9% average annual rate of return isn't that unheard of. So you could actually accumulate over $400,000. However, if that 25-year-old waits just 5 years, waits till they're 30, does the same thing, saves $100 a month through age 65, that's $42,000 out of their pocket, only $6,000 less than if they would have started at age 25. But if we look at the other end, at a 9% average annual rate of return, then that's a difference of $180,000. So again, time is money. You got to start saving as soon as possible. Next slide, please. Okay, so let's talk about some of the ways that we can save and the accounts that we can save in. Now, with this graph here, the reason it's overlapping is because we're going to be talking about employer plans as well as IRAs, individual retirement accounts. The thing about these plans is that there are some rules that are the same and some rules that are different. So this is why we have this type of chart. So I'm going to cover the employer plans first. With an employer plan, some of you may have the availability of a 401k if you are in private industry. If you are with a nonprofit or the universities, you will have a 403b. Municipal workers also have what is called a 457 or a deferred compensation plan. So any of these plans are only open through your employer. Now, there could be a possible match from your employer. If that's the case, like Christina said, you want to make sure that you do contribute at least to get the match. And like she had said, it's free money. Not really, because someone did work for that money. So the nice thing is, though, is that it could be available for you. And then with employer plans, oftentimes you're limited to the investments that you can contribute to. Now let's take a look at individual retirement accounts. Individual retirement accounts, often called IRAs, they are not associated with any employer plan. This is for the folks that maybe do not have an employer plan that they can contribute to. They're working, but maybe it's a small company and that company does not offer a 401k. Their option is an IRA. Anyone can open an IRA. It does have tax deduction income limits. So with IRAs, if you make over a certain amount, then all of your contribution may not be tax deductible. And then you can have a variety of investment options. With those investment options, you choose which investments that you want to contribute to. Now, the contribution limits for 2023, they did increase. So for IRAs, individual retirement accounts, for anyone under age 50, you can contribute $6,500 a year. For age 50 and older, you can contribute $7,500. Now, employer plans are much higher. The IRS is very generous with employer plans. With an employer plan, you can actually contribute $22,500 per year if you are under age 50. Age 50 and older, you can actually defer up to $30,000 a year in your employer plan. Now, these earnings in both employer plans as well as IRAs will accumulate on a tax-deferred basis. And there are definitely some tax benefits, and that's what we're going to talk about now. So next slide, please. Thanks. So with the tax benefits, what we're seeing here is that oftentimes you'll have the availability of contributing on a pre-tax basis or an after-tax basis. So which one is right for you? Well, that all depends on your situation. And I'd like to say here that, you can do a little of each. It doesn't have to be either all pre-tax or all Roth. So you may want to contribute to both, but have in mind what bucket you are using these dollars for. So for example, if you're getting close to retirement and you know that you will be going in a lower tax bracket after you do retire, but you still want to save, then maybe while you're in your higher earning years, you'd want to do pre-tax. So with pre-tax, you say, I'm going to forgo paying the taxes now. It's going to grow without you paying taxes. And then when you start to take a distribution, that is when you would be taxed. So you're going to pay the taxes when you are in the lower tax bracket. So if you need that tax break today, maybe pre-tax is good for you. Now, for those that have a longer time horizon, if you're in your 20s and 30s, you can contribute to a Roth plan. It's after tax, meaning I want to go ahead and pay the taxes on the dollars that I'm contributing right now. It's going to grow without you paying taxes. And then what you want to do is, as long as you keep the funds in there with a Roth account until age 59 and a half, you withdraw those funds. All the earnings that have accumulated over the past 30, 40 years, all of those earnings will come out tax-free. So if you do expect to be in a higher tax bracket, or you do have a longer time horizon, then maybe the Roth account would be the better option for you. So with a Roth, you're saying tax me now versus later. Next slide, please. So it's not only important to consider the taxes when you are contributing those dollars, but you also have to plan for taxes in retirement because there are taxes. You'll be taxed on Social Security. However, you will be getting a tax break in terms of not 100% of that Social Security income will be taxed. You will either be taxed on 50% or 85% of that tax income. So it all depends on what your income is at the time of retirement. Pensions, in most cases, are taxed. And then with your 401ks and the 403bs and the 457 defined contribution plans, if they are pre-tax while they are growing, then keep in mind, when you take a distribution, you will be taxed at that time. The annuity income Again, depending on if it is a pre-tax purchase or not, which Patricia, I'll let you handle that with the next presentation. And then most non-retirement investments are taxed, such as CDs, your savings accounts. Now, there's one important thing to keep in mind when it does come time to retire. Those are what they call required minimum distributions. Now, with required minimum distributions in a Roth, you do not have to pay. That is not part of the required minimum distribution. This refers to pre-tax dollars. So if you have a pre-tax IRA, also known as traditional, or a pre-tax or traditional 401k or 403b, then you would have to start taking a required minimum distribution. Basically, Uncle Sam is saying, okay, we've let you go this far without having to pay any taxes at all. We'd like our share. So that's what's happening there. But under the Secure Act 2.0, there have been some changes in the required minimum distribution. The required minimum distribution has now increased starting in 2023 to age 73. And then starting in 2033, it's increasing to age 75. So you can start delaying those required minimum distributions for a while. So I also want to remind you, though, is that IRAs, whether you are still working or not, are subject to the RMD. Now, 401ks, if you are with an employer and you're contributing to your 401k, you still have your 401k, you're still working beyond age 73, and later on age 75, then you don't have to take that required minimum distribution as long as you are still working. You don't have to take it from that particular 401k. So keep that in mind. So as it says here, RMDs from employer plans are not required if you are still working for the employer at the RMD age. All right. Now, RMDs on Roth 401ks and 457s are not taxable as long as they are qualified distributions. Now, I spoke a moment ago about the Roth. You pay the taxes when you go ahead and make those contributions. It grows without you paying taxes. And as long as you meet several requirements, then those earnings will not be taxed. So what are those requirements? Well, you can't make a withdrawal, take a distribution until after 59 and a half. Once you're at age 59 and a half, you can go ahead and tap into your Roth dollars and not have to worry about paying taxes. That's one rule. The other rule is that first contribution that was made, you can't take a withdrawal until the account, that contribution, that first contribution amount has been in the account for at least 5 years. So as long as you established your Roth 5 years prior to you taking any withdrawals, you've passed that and you have to wait until 59 and a half. Once you meet those requirements, then you will not have to pay taxes. And then next slide, please. Finally, some tax efficient withdrawal strategies. You want to go to your required minimum distributions if applicable. Cash flow from taxable non-retirement accounts, okay? Principal in the taxable accounts. Then this is just a timeline. Then take your tax deferred if you have them, and then, leave that Roth account. But again, it depends on your situation when you are withdrawing these dollars, but this is just for illustrative purposes only. So you want to talk to a tax professional, because the idea is you want the most tax efficient withdrawal strategy. So you want to try and keep as much money in your pocket as possible. So I know this is a lot of information, and I'm sorry I can't give you a hard and fast, it's going to take $1 million or $2 million, because everyone's situation is different, but you've got to look at all those different sources of income. You've got to think about, how do you want to spend your retirement? And you've really got to factor in inflation, factor in taxes, get that number, use the resources that are out there, and, you've got to save, and again, get those SMART goals like Christina had mentioned. Okay. And that ends my presentation.
Thank you, Jenny.
So thank you.
So next we have Patricia Dorn, and she will be presenting in a minute. Okay, there we go.
Thanks, Yana. Just 1 second. Just get my slideshow up. All right. Hi, everyone. My name is Patty Dorn, and I am with the Maryland Insurance Administration. I'm going to be your last speaker for today, and I'm going to touch on annuities, life insurance, and the IRS 1035 exchange. So the emphasis on this being the IRS 1035 exchange, but I just want to make sure that, we know what an annuity is and we know what we're talking about with regards to life insurance before we get into that. So what is an annuity? An annuity is a contract between you and an insurance company under which you make either a lump sum payment, one payment, or a series of payments. And in exchange, the insurance company agrees to make payments to you in the future. On the right-hand side, you see our consumer guide to annuities, which is a very useful brochure that is published by us at the Maryland Insurance Administration. The amount of the annuity payment, it depends on the terms of the contract and the market environment. So it typically varies depending on the amount of the original payment, the length of the investment, and withdrawals, among other factors. Although annuities are not life insurance, most annuities do include a death benefit. Annuities are frequently used as an investment tool. However, they may not be the best investment option for you. And so Christina and Jeannie went over some of the other options. Annuities is just one of those things. An annuity can have a number of features, requirements, and options. The details can be difficult to understand. That's really important. Annuities can be incredibly complex, and you should be incredibly cautious about purchasing an investment product that you don't understand. So even for an experienced investor, annuities can be complicated. It's strongly recommended you consult with a trusted advisor if you are considering purchasing an annuity. You can gain a better understanding of an annuity by knowing the answers to these questions. How does the annuity earn interest? Is it fixed or variable? How do you pay premiums into the annuity? How does the annuity pay you? And administrative fees, what charges does the annuity have? Is there a surrender fee? When does the annuity start paying you? These are a lot of questions. It's a lot coming at you at once. And I'm not going to do a full annuities presentation. What I'm going to say is if you want the full annuities presentation from the MIA, you can find it on this link that's here. You'll get all of those questions answered as well. You can download the slides for all that information. And you can watch recorded videos that I've done in the past where I present all of the slides, whatever works for you, recorded or just reading the slides. We just don't have time today to do the full annuities presentation. I just want you to understand what an annuity is before we talk about the 1035 exchange. So both annuities and permanent life insurance products are contracts between an insurance company and a policyholder. Life insurance pays a benefit in the event of your death, and annuities are generally designed to pay you income while you're living. Not all annuities contracts pay a death benefit upon the death of the annuitant. All right, so we're going to talk about life insurance now. We're not going to talk about term life insurance too much, but I need you to understand what the difference is between a term life insurance product and a permanent life insurance product. Because when we talk about the 1035s, we're talking about the permanent life insurance products, not term. So term insurance covers you for a term, 1 year, 10 years, 30 years, while you're working your current job, whatever that term happens to be. It only pays a death benefit if you die during that term, and it does not build up cash value. Okay, so important, term life insurance is not building up cash value. And when we talk about the exchanges, we're not talking about term life insurance products. We're talking about the permanent life insurance products. Permanent insurance includes types such as universal life, variable universal life, and whole life. Each contract provides long-term financial protection. Meaning unlike term, like term has a limit, right? 10 years, 30 years, the job you have now, whatever that term is. With permanent, oftentimes you have the product for your entire life. So because of the savings element, premiums tend to be higher for the amount of insurance that you're getting with the permanent life insurance products. It can be whole life, universal life, variable universal life, and there's some other options as well. So this is just important for you to understand that when we talk about the 1035 exchange, we're talking about permanent life insurance products. So using a 1035 exchange to convert a life insurance policy to an annuity. Some or all of the cash value of a permanent life insurance policy may be converted to an annuity without negatively impacting your tax status. This is called a 1035 exchange under the Internal Revenue Service, IRS, and you can get more information. There's a link here. You can request these slides or you can see them online and be able to use the link. This is a tax-free exchange of a life policy or annuity for similar coverage. So an IRS Section 1035 exchange allows annuities to be exchanged tax-free for other annuities. So annuity to annuity. Life insurance policies to be exchanged tax-free for similar life insurance policies. All right, so annuity to annuity, life to life, and life insurance policies to be exchanged tax-free for annuities. Annuity to annuity, life to life, life to annuity. Okay, so what's missing is annuity to life, and that's not part of it. It's annuity to annuity, life to life, life to annuity. In many cases, you can convert a permanent life insurance policy into annuity without paying taxes on your gains. You may give up the death benefits that are payable upon the death of the insured under the life insurance policy. So I think it's important to think about that for a second. If you choose to do this, so if you're converting a life insurance policy, so you're converting the cash value, you might give up the death benefit. And I say might, I cannot answer that question for you. That's going to be based on the terms of your policy. While the exchange is tax-free exchange, you may still pay taxes on a portion of each payout under an annuity contract. And you can find out a lot more about that by watching the annuities webinar or, going through all the slides or reading the annuities brochure as well. The reason these policies are allowed to be exchanged tax-free is that no actual gain has been realized by merely exchanging the policies. This is not a withdrawal. So it's not a withdrawal where surrender charges could potentially apply. This is an exchange of a policy for a similar type of coverage. Okay, so it's not a withdrawal, it's an exchange. While an annuity may have gained value, positive return on investment, perhaps you hopefully got a positive return on your investment, the gain has not yet been realized as long as payments haven't been distributed. If you're looking at a 1035 exchange for the purpose of long-term care insurance, you may also be able to exchange your existing life insurance policy for one that combines life insurance and long-term care insurance, or exchange your policy for one that includes a long-term care insurance rider. So that is something to think about, but you need to make sure that you understand the terms of these policies, which might have restrictions. So if this is something that you're considering, you definitely need to be working with a professional who can help you understand what you're giving up for what you're getting, essentially. A financial planner can help you find a policy that suits your needs. You're definitely going to have to be consulting with professionals in an exchange like this if you're not already a professional. A trusted financial advisor or a financial planner should absolutely be consulted when you are making these decisions. So this is just to make you aware that this is a possibility and it might be something to consider in retirement or as you get close to retirement. We have some more information on our website about annuities, a little bit about the Maryland Life and Health Guarantee Corporation, and information about trading your annuity for a new one, as well as all kinds of other information on our website. That is my presentation. So I think we're going to go to the Q&A.
Thank you, Patty. So it looks like we just have a few questions. Jenny, it says, will a RMD be needed if you start taking out the money as soon as you retire?
Well, that's a great question. So it depends on your age. The factor is the age and whether you are still working. So if you retire and you are at the required minimum distribution age, then you will have to take that RMD. So first question is how much is it? And it's basically based on the assets that you must withdraw from. So some of your assets could be Roth, some of them could be pre-tax. It's definitely going to be from the pre-tax dollars. So that required minimum distribution amount is based on those pre-tax dollars plus your age. And there is a factor, and you can find a chart on the irs.gov website. And so you may have to take that required minimum distribution once you separate. So if you take any amount, the IRS doesn't mind if you spend your money. So you have to take a required minimum amount. You can take any amount above that you would like. Just keep in mind that you will pay taxes on those distributions in the year that you take those dollars out.
Thank you. Nora, I don't know if you want to elaborate on your response to the question, what are qualified distributions? You put something in chat.
For qualified distributions, basically that's based on if you were to withdraw things out of your 401k or 403b. I think Jean can better answer that question. She was presented, so I wanted to provide some kind of input. What I can sort of add on the annuity contracts as a supplement to your retirement, annuity contracts is one of probably the sole vehicle that will provide you with lifetime stream income. There are a lot of factors, but you have to understand what you're buying. So basically the difference between what a fixed annuity is, what a variable annuity is, what an index annuity is, it makes a difference whether its payments are immediate or deferred. Whether the interest rate is guaranteed. If you have, like, for example, an index product, you want to know what the participation rate is, what the cap is. All those terms are in your contract. So both the company and producers have the responsibility to provide you with information at the time of sale to make sure you understand what you're buying. And again, that's it's a best interest requirement. And again, it's best to talk to a financial advisor to make sure what you're buying is exactly meet your financial needs. Thank you.
Jenny, did you want to add anything to that?
No, I think that's fine. The qualified distribution, as he had mentioned, is that it's those dollars that, and most of it pertains to the Roth, that you have to meet those rules. Once you meet those rules, age 59 and a half, and the account must be established for at least 5 years before any withdrawals are made. Once you meet those rules, then that distribution is called qualified.
So it looks like someone wanted more elaboration, I guess, when the deceased spouse, if your income is higher and you decide to take yours rather than the deceased spouse money, what happens to it?
I'm
Social
guessing
Security.
Social Security. Yeah, okay. Well, it goes back into the pot, so, you're only allowed to take, the surviving spouse can only take the higher of the two checks. So as a surviving spouse, you want to make sure you take the higher check and let the lower check, that will stop, and it will go to help all the others that are getting a Social Security benefit. So, yeah, you really need to reach out to Social Security and make sure, because there's all different kinds of rules. These are just the basics. And that's why I say, planning for retirement is a process. There are so many things that are involved with planning for retirement. But, the most important thing is to get in and start saving. because again, you want to get to that position where you're working because you want to, not because you have to. And time can really make a huge difference in that. Someone did ask about a simple IRA, and that's usually for smaller companies. So it's a way for smaller companies to not have to have quite as much rules and processings and oversight as a 401k. So it works very much like an individual retirement account, but it is for smaller companies usually, or even self-employed individuals.
And I believe there was the first question. I am 71 and planning to retire in 2 years. When I am 73 and need to start taking an RMD from all my tax deferred investments, 401ks, traditional IRAs, and Roths. If I understand correctly, can you tell me more about the RMDs that I've heard are coming sooner?
Well,
than-
that's it's actually, they're delaying the time. The Secure 2.0 is actually allowing folks to not have to take out their their RMD, the required minimum distribution as early. It used to be age 70 and a half. Then it went to age 72. And now starting this year, it's 73. So folks are able to delay taking that required minimum distribution. So you would have to take, if you stop working, if you're no longer working, you would have to take distributions from your pre-tax 401k and traditional IRA. You should not have to take money from your Roth IRA, your individual retirement account. And then again, it goes by a formula. You can find that on the irs.gov website, and just search for required minimum distributions. There is a chart. I can tell you that the first required minimum distribution, if it were to be taken at age 73, is going to be around 4% of those total amount of assets that are subject to the required minimum distribution.
Thank you. If there's no more questions, I would like to thank everyone for attending today's event. This will be on our website, the recording, by next week. So again, you can look at it and refer if you missed any of the information that was presented today. To help us evaluate the quality and content of today's event, there will be a survey that will be put in the chat. If you could please take the time to fill it out, we appreciate your feedback. I would like to thank all the presenters today for the great information. I know it's a lot to absorb and get ready for retirement, but we appreciate the quality of information we received today. So thank you all for coming, and I'd like to thank everyone for attending today's event. If you are interested in any more webinars that we may have, you can also get on our website, which would also be put in the chat, www.insurance.maryland.gov, or subscribe to have our outreach calendar delivered right to your inbox. Again, thank you. Please follow us on social media. We are everywhere: Facebook, Twitter, LinkedIn, you name it, you can find us. So again, thank everyone from the Maryland Cash Campaign, the Maryland Supplemental Retirement Plan, and the Maryland Insurance Administration for the information. Thank you, everyone, and enjoy the rest of your day.
Thanks, Kiana.